the tariff discussion is only one leg of the administration's strategy. And I like what you said in breakfast earlier. It doesn't matter if you agree with the administration or disagree with the administration. I think we can all agree that we hope this gamble works. We want this to work, because if it doesn't, it could be pretty ugly. We could see a recession. I think it's not the end. It's not going to be a depression, but it's not going to be, a quick snapback V-shaped recovery. So, in the market at least. But here's what I believe is going to happen.
Welcome to the Money Alchemist podcast. My name is Brent Gargano.
My name is Ben Jones.
And we are here today to talk a little bit about recent market volatility. I feel like this has been something that we've maybe beaten up a little too much in the last couple of months, but it continues to be at the forefront of everybody's mind. And so I think it's worthwhile to have conversations about it.
Yeah, kangaroos are fun to watch, but they're not fun to ride. And that's what we have right now is a kangaroo market, and we're on its back, just getting wrecked.
So today we wanted to spend a little bit of time diving into what does this down market actually look like relative to history, a little bit of information around some of the other historical market crashes that we've seen, what to expect moving forward, and how you, as an investor, as somebody who's looking to be smart, building and maintaining wealth, how do you see through some of these headlines and get a little bit smarter about your money? Ben, we talked. I almost felt like we were beating a drum pretty hard with the fact that we talked, I think, about market investing behavior 2 episodes in a row, just 2 episodes ago. So I hate to do it again, but I think given the context, I don't think anybody right now is unaware of what's going on in the stock market.
Oh yeah. As we were talking, it's the 5th worst start to the year since 1928. So even worse than the 1929 market. Of course, that sell-off didn't happen till later, I think in the fall. But yeah, it's been pretty ugly. And the reaction to it from our clients has been they're feeling a lot of acute pain right now. So I've had to field quite a few messages, emails, phone calls, just people very concerned about what's next. I don't necessarily think that they're concerned about the losses so far, because we've been through markets like this. Actually, just recently, from 2021 through November of 2022, it was kind of death by 1,000 cuts. The market just melted down. I think the NASDAQ was down over 30% over that time frame. The S&P was down just over 25%. So, and that's not too long ago. That's less than 3 years in the rearview mirror. Yet now it seems like it's a little bit more painful. Why do you think that is?
Well, this, as you mentioned, I mean, this correction we've had in the market, I think we can officially call it a bear market. I don't know. I mean, I think the S&P touched down 20% for about
intraday, yes,
for about 10 minutes.
Yeah,
and we've talked about this before. Market bottoms are not easy to catch. You often talk to clients about getting money to work in these situations, and their concern is, how do I get it to work at the very bottom? If I think there's another 5% downside, how do I make sure that I capture that? And I try to remind them that a lot of times, like those bottoming moments, they are blips.
Yes.
We had yesterday morning, for timeline of events, today is Tuesday, April 8th. I don't know what the future is going to hold, but looking back to last week, Thursday and Friday, the S&P was down 11%, roughly, right? So 11% in 2 days. And then over the weekend on Sunday, of course, about everybody's phone said Dow futures tumble another 1,000+ points.
Mm-hmm. Yeah, Jim Cramer was saying that on Monday we were going to have
Black Monday.
Yeah, we were going to have a Black Monday, and then market circuit breakers were going to trigger, which didn't happen.
We didn't see any market circuit breakers. Now, some of the international markets did. Notably, yesterday, throughout the beginning of this year, we had seen international stocks hold up pretty well. That all fell apart a couple of days ago. So, but your question was, why do I think people are skittish? I mean, let's face it. We talk a lot as advisors about the importance of being able to stay mentally resolute throughout market volatility, but like losing a tenth of your portfolio in 2 days is a little unnerving.
Oh, a little. That's a lot unnerving.
Nobody likes to lose money, even though for a lot of our younger clients, it may actually become a really a good thing.
Well, it's almost similar to losing a loved one. So like what my wife and I watched a Netflix series, Adolescence. Have you seen this?
No.
Oh man, it's a bit strange. It's weird. It's one of these continuous shows where, there's no cuts in the filming. It just, goes from one scene to the other. Anyway, I won't spoil it for anybody, but basically bad things happen in this kid's life, and then the parents are just wrecked with regret. Like, I should have done this, I should have done that. And I feel like the same sentiment, the same human reaction is true when it comes to managing your portfolio. The amount of times I've had to address that, man, I should have just sold everything in January. It's like, hindsight's always 20/20. And people are just wrecked with negative emotions because now here we are, 20% down on the S&P. By the way, I don't know what index we're supposed to use to officially declare a bear market. I think maybe the S&P 500, but that's not necessarily the broadest index because, you've got the Russell 2000. That's been in the bear market for a while. I would say at least since March.
Well, it's just the Russell really hasn't come back. I mean, the Russell, let's face it, really peaked in 2021.
Yeah, and it's just struggled.
And now the Russell was the first to enter a bear market. For the listeners that may or may not know, a bear market is defined as more than a 20% pullback. And I guess it's relative to the index. For us as advisors, a lot of us are using the S&P 500 index as a broad measure of the U.S. market. A lot of times the news sources will use the Dow just because it's the index that's been around the longest. And the Dow has the biggest swings because it's got the highest points. So I think the news likes being able to pump you a message that says Dow loses 1,000 points or something.
It sounds monstrous. I remember, we were going to talk about historical market declines and, how this recent decline compares to history. And, one of the things I recall from 2008 and 2009 is when the Dow did fall 700 points. Nowadays, it sounds like nothing, but when it fell down, that was when the Dow was 7,000.
And as a 10% drop.
Yeah, it was a 10% drop in one day. And that was huge. But I remember that was the number 700 was posted all over on these websites, but it actually was a big deal. But one other thing I wanted to comment on real quick is, what's triggered this sell-off, because right now, tariffs is, the fear du jour, and it does have a lot to do with this. I personally think that the sell-off kind of started with the whole. Well, first of all, the stage was set with unrealistic valuations. We had last year we had the Mag 7 took off. Really, it was anything that had anything to do with AI. AI was the rage. It still is kind of the rage, but prices got to very unrealistic valuations. I think momentum mixed with just over optimism took over. And then DeepSeek happened. DeepSeek was this weekend event where it was discovered that maybe we don't need as much compute as we thought to train these models. And ever since then, that enthusiasm in the AI space, which was what really was fueling last year's performance, kind of, stalled. And then you throw in now the uncertainty of the tariffs. Now, I think that the market's panicked, and a lot of people are just assuming kind of worst case scenario that we're going to have runaway trade war. what I equate tariffs to, it's like economic chemotherapy. You know, they're not fun while you're going through it, but they're designed to address a problem, an economic health problem, if you will. And, you know, you can, it's a gamble. You're either going to come out worse off or you're going to come out cured and healthier.
But let's walk through what actually happened last week and why the market reacted the way that it did.
Yes.
Because we have said it many times when we talk about this market timing stuff, that the market doesn't react to information that it already has. It reacts to new information. So, you know, when you're out there and you're like right now, everybody's talking about a recession. So frankly, the recession may not be as bad from here as the market is worried about, because the market's already pricing some of that in. But what it doesn't price in is information it doesn't know. So what happened? And I watched this. So I was watching this in real time. We had Liberation Day, as it's called, right? And the whole day is spent anticipating. I mean, the build up to this event was theatrical, right? And then they're going to speak at 4:00. So markets are going to close. Trump's going to get up and he's going to have this speech where he announces his tariffs. And he's been talking at that point for weeks about the idea of reciprocal tariffs. And so for weeks, we saw charts of quantifying other countries' tariff rates and what they call non-tariff barriers, right? And so there's all these charts floating around the investment world that we're trying to get the point across of what might Trump be doing with these, quote, reciprocal tariffs. And everybody's guessing, how is he going to address the non-trade barriers? Is he just going to retaliate against the tariffs? What about the non-trade barriers? And so Trump gets up and he's giving his whole spiel, and he's, you know, talking about how they're going to be reciprocal, right? You do it to us, we do it to you.
Yep.
I think that's what he said, right? And as he's saying that, reciprocal, the markets are the after hours markets, I should say, are jumping. I think I watched the futures up 1.5%.
Yeah.
And then he looks at Howard Lutnick and he says, "Hey, Howard, do you have that chart for a second?" And they bring up what you remember when you were in middle school and you would make those poster presentations and you go buy one of those poster boards. Like he bought up one of those poster boards and he flips it around, and on there's a list of countries on the left. The middle column is the tariff that the White House is saying that the country hits us with. And then the right-hand column is the, quote, reciprocal tariff that we were responding with. And everybody in that moment looked at that chart and said, where did the numbers come from? Right? And all of a sudden, again, back to markets don't react to what they expect. What the markets expected was that Trump, the White House, are acting kind of in the realm of like what the quantifiable tariff is per the, you know, trade agreements. What they got was actually an equation that really more represented what the trade imbalance is.
Exactly. Yeah.
And then these meaningfully higher than expected retaliatory tariff rates. And it was just like, you know, from there, I mean, effectively Thursday and Friday, everybody there were a couple of times where we watched and saw some buyers trying to step into the market, and they just got
they got
absolutely steamrolled.
Yeah.
And then we had the weekend where we had Sunday night and the futures went down 5%, and we got, you know, kind of what I think a lot of times can be, back to what we said earlier, the hardest part of catching a bottom, which is that these bottoms are very quick. We opened up down 5% on Monday. About 20 minutes later, we were back to break even. I think by 10 o'clock in the morning, we had some fake news story about potential pause in the trade negotiations, and the markets were actually up 2% before we found out that was fake news, and they kind of, you know, settled on break even for the day. And today, at least for today, they're up. But there's no question that this year, I mean, back to that chart that we were referencing at the beginning, the first 65 days of 2025 is actually the 5th worst start to the year in history. And I want to point out that the 1, 2, 3, and 4 include years like 1932, 2020, and 2001 and 2020.
Mhm.
So we're not talking about, I think in the investment world, when you start throwing those years around, those are not fun years to be comparing yourself to.
No. Interestingly, though, um, after the first six on those each of those years you provided, it was the first 65 trading days that were the worst, and then the remaining days in the year we had a nice market rally. So the lesson to learn from these historical bad markets is that you really don't want to give up when the pain is at its worst, when the pain is at peak, because then chances are you're going to stop yourself from participating in a recovery. And every single one of these markets, 2020, which was in the first 65 trading days, was down 23%. Here we're talking about the S&P 500. 1932 is down just shy of 20%. 2001, 16.4%. So each of these was pretty bad. But the latter half of the year, every single one of those years was positive.
Yeah, it looks like if my rough math is correct here, it looks like between the 66th day
Mhm.
and the end of the year, in the other 9 of the top 10 worst, the average return is something like 20%
Mhm.
through the end of the year. And there's a couple of those that are actually negative through the end of the year, but overwhelmingly, it is positive, a positive return from day 66 through year end.
Yeah. So historically speaking, and I know history doesn't repeat, it rhymes, they say. Uh, you're better off just hanging on to your allocation and braving the storm. The one comparison I'm seeing pop up time and time again now is this whole Smoot-Hawley Tariff Act of 1929. It's funny that I never heard about this act as it pertains to the Great Depression until the recent tariffs. It's all of a sudden now the Smoot-Hawley Act was the thing that triggered the Great Depression. When, in fact, like all the books that I've read, all the studying that I've done on the Great Depression, I'm far from an expert on this stuff, but I feel like I'm pretty well educated on the events that led up to the Great Depression. It basically was economic excess that was encouraged by central banks. Um,
Caused by central banks. Isn't that a little bit of what we have today?
Oh yeah, we have excesses today, but the excesses aren't in equity speculation. The excesses are in sovereign debt. It's in government deficit spending. I don't think it's in equity markets. You could argue that AI is in a bubble and all that, but look at the earnings. The earnings are supportive of these extreme valuations, and I would say the valuations aren't extreme. They did reach some extreme levels with some very specific equities, but the market as a whole, especially if you look at equal weighted S&P 500, is not
Yeah,
extremely
it definitely
valued.
wasn't like 2000
Yeah,
level overvalued.
yeah. So I don't think that this is equivalent to the Great Depression. So the Great Depression was kind of the perfect storm of, we had the Federal Reserve, which was founded in 1913, that was encouraging a lot of easy money. It was inexperienced at setting policy. So we had artificially low interest rates. You had banks that were completely unregulated. They were literally taking deposits, 100% of the customer deposits, and speculating with that money in the stock market. So of course you get this massive asset price inflation, and then you have a normal recession that causes a flight to safety in the stock market, which is what happened. And then you just get this cascading effect of asset devaluation. You got asset prices, these stocks, which a lot of it was considered malinvestment by economists. I follow quite a few, but generally they all agree that there was a lot of stocks that shouldn't have been worth what they were worth. And of course, the stock market's not a zero sum game. It's you literally get asset price inflation. So you get money you get wealth that's created out of nothing just due to demand. But anyway, that bubble got popped, and then people freaked out. There was a run on the banks. People found out what the bank was doing with their money. So they ran to the banks and they said, "Give me my money because I don't think you have it." And sure enough, they didn't. And then banks started folding one after the other. And then that created a domino effect of not depreciation. What's the deflation? Asset price deflation. You literally had just money. You had capital that just was destroyed. And it took the market a long. This was the first time this had ever happened. The market had never seen a fiat currency deflationary event before, liquidity crisis. And it took the market a long time to work out from that. And that's I'm not going to talk about the recovery. That's beyond the scope of today's
but like
podcast.
To the point,
Mm-hmm.
there were problems that we found in the plumbing, like real financial crises.
It wasn't the
happen.
Smoot-Hawley Act that did it.
Right. Well, one, you already had a weak economy going into that act, right? Which is pretty different than we have today. Okay. I mean, as much as we're talking about recession right now, that and full disclosure, like economic data is rearward looking. So generally by the time you're actually in the recession, it kind of doesn't show up in the data until it does. But from all the data that we have through March, inflation is reducing. Wages are rising. People are gaining jobs. Like we didn't go into this in a weak place economically.
Yeah. The last jobs report was quite strong.
And that was for March. And we knew about, I guess we didn't know about exactly the tariffs in March, but we knew they were coming.
Yeah. So, I don't think that what we're looking at, we're not facing an abyss. Actually, the people in 1929 had no idea they were even looking at an abyss. So that's another signal that tells me that we're not about to head into Great Depression 2.0 is the fact that we're just very concerned about it. The fact that we're worried about it, whereas in 1929, it wasn't even on anybody's mind. It was just, this gravy train was going to run forever. So the fact that we're concerned about it shows that there probably are banks and financial institutions and even individuals that are conservatively positioned within their investment portfolio where they could brave the storm. Because if you're concerned about something, you're probably going to put risk controls in place to protect yourself from that concern. So, I really don't think we're heading into a massive financial collapse. And then the next closest thing to the Great Depression was the 2008-2009 financial crisis. Boy, we could go into another 30 minutes dissecting that event. But suffice it to say, it was another deflationary liquidity crunch. Banks, again, it's the banks that were the problem. They speculated on CMOs and CDOs. And before you're like, well, I thought we had regulations in place to protect it. It's like, oh, they're all AAA guaranteed. You remember? You had companies like AIG that were slapping insurance on these portfolios.
These things.
Yeah, they were insuring these things and basically stamping them with the AAA when in fact you looked at them and they were terrible. They were garbage investments, but they levered these things up. And sure enough, the banks had over-speculated. They overextended themselves. We had a normal recession that triggered a domino effect, and it ended up in a deflationary event, which took more than 3 years, about 3 years to claw back out. Fortunately, regulators and just the financial system in general had learned from the lessons of 1929. So we clawed out of that pretty quickly and did not suffer decades of stagnation. But that was a financial liquidity crunch that affected banks. Where are banks and financial institutions affected from tariffs? Show me where. Point on the doll where the tariffs have hurt the banks. It's not hurting the banks. The banks simply just react to it. It's almost a neutral event. Tariffs don't affect capital like dollars.
The plumbing of the system.
Yeah. So this is impacting the tariffs impact trade. And if you look at trade, like a lot of people freak out about China. Oh my gosh, the Chinese, it's the tariffs are 68% on China. That affects 427 billion per what was this? I forget. It was like the Bureau of Economic Statistics or something, but and also supported by the IMF. But about $427 billion come over from China. Yeah, it's a big number. But when you compare it to the size of the U.S. GDP, it's not that meaningful. It really isn't. In fact, the Chinese economy is only 2.38% of the Chinese economy is dependent on exports to the U.S. So this doesn't really, it hurts China. Don't get me wrong. I'm not trying to say it has a zero impact, but it's not catastrophic. We've seen trillions of dollars in equity evaporated in the past 2 weeks over these tariffs, when in actuality, the tariffs really just don't have that much impact on economic plumbing. So, I don't think that the market has reacted appropriately to the
Well,
tariffs.
I think you're partially correct, but what happens if these other countries, more or less coalesce without the U.S.?
Well, to some extent, that's already happened a lot. I mean, our the global markets are
Do you
not
think they
reliant
can
on U.S.
shut the U.S. out?
Yes, I do think they can, but it wouldn't be in their interest to do so. So I think the most likely outcome, and I think that's why the administration's gambling on this, and it is a risk. Like as I said, going in, it's economic chemotherapy, and I don't think that people go into chemotherapy expecting a fun time. They're expecting a positive result, but there's a chance it may not work. So, and I think that's what markets are teetering on, is they're thinking, oh, it's not going to work, and then you get the panic priced in, and that's where we're at today. Of course, today the markets are up almost 4%. So now I guess they're thinking everything's fine. And
the word of the day is negotiation right now.
Correct. So now I'm
optimistic. As we say that, supposedly these bigger tariffs come into effect tomorrow.
Yes. I'm actually optimistic. I think that, it's possible that Europe and China and a lot of these, countries, most of the tariffs affect actually Mexico and Canada. Our two biggest trading partners are Mexico and Canada. I don't think it's possible for Mexico and Canada to shut out the U.S. I really do. I think that they are going to have to come to the table because it's just so much of their economies rely on exports to the U.S. However, Europe and Asia, they probably could, but it wouldn't be in their interest to do that. I think that the most likely outcome of the tariffs is that they're going to come down from where they currently are, from this high 25% mark that what they're at, and they're probably going to moderate to something higher than where they were, but lower than where they're going to be as of April 9th.
But I think what the point of all of this, because, for listeners that are listening to this 2 weeks from now, I mean, this is all going to be a little stale, I'm sure. So the question is like, okay, what does this mean for how you approach markets? I mean, we oftentimes feel like broken records as advisors telling clients, we've got to stay invested and stick to the plan. But it's really important to have processes in place so that you're prepared, at least emotionally, for these downturns. You can make lemons out of lemon, or lemonade out of lemons, so to speak, through things like Roth conversions, tax loss harvesting. These moments are not moments to try to, as I like to say, to get cute. These moments are times to, pull up your pants, pull out your down market playbook and play a little bit of defense so that you can play offense later. And I'm not saying that fits for everybody, because everybody's got a different place in their plan, but it's really important at any moment in time in the market to acknowledge that downturns happen. They're normal. Just because we're in the middle of a downturn doesn't mean we throw out all of the rules that this, that your financial plan is based on. What it does mean is we have to put the blinders on to some extent and make sure that we are, I say don't check your balance, because it's not necessarily worth the stress of looking at your balance. It changes so much on a daily basis when the market's moving like this. But think about the pragmatic things that you can do. We've talked about this before, but again, tax loss harvesting, Roth conversions, rebalancing, reassessing positions in portfolios, gifting strategies. Like there's a whole list of ways that, regardless of your situation, you can take advantage of these periods of volatility.
Yeah. And I don't even think the focus should be how do I arbitrage this volatility. I think that we get caught up on that. If, for example, I think about my own life, I feel like my cash reserve is in a good spot. So I'm not going to jump on this market. I'm not going to say, oh my gosh, look at these bargains. I'm going to, put as much of my cash as I can in the markets, because it could go down further. And that's ultimately not the objective that I'm trying to achieve with my cash. That cash is there as a just in case. What if my wife decides that she wants to remodel the kitchen right now, which is something that she's looking at. But I think that the other thing that you can do isn't just like, okay, how can I take advantage of this down market? It's, you should be looking for, you should not be paying so close to attention to your portfolio where it's impacting your day-to-day life. If it's impacting your day-to-day life and your thought process, you're paying too much attention. You have no control
Well,
over this.
how can it, it's almost so hard. It's easy to say that, but we're all getting the push messages to our cell phones.
Turn them off. I think that if you're concentrated, if you're trading and you're trying to leverage risk to your advantage, and this is like your thing, and you're essentially gambling with your money, then you have to pay attention. But I don't propose that people do that. I advise that you approach investing with a boring, sensible asset allocation. I don't think you need to get crazy and concentrate your portfolio. And I think you and I are aligned.
Yeah,
with
I
this.
think we all agree on this. What I'm pointing out is that,
Mhm.
like in your situation, maybe you don't have more cash. I mean, I'm not advocating that people invest their emergency savings, but I guess what I am advocating is that you look at your specific circumstance, and whether you work with an advisor, what have you, identify what are some of the things that I can do proactively to make sure that I'm well prepared to get through the market downturn. Because at the end of the day, market downturns are part of investing. They're going to be part of your life, whether you are in accumulation mode or you're a retiree. And, this is not going to be the last time that we see a market downturn. And while I don't think it's important to try to sit here and call bottoms, I do think that behaviorally, it's good to think about, what do you want to change? And I'm not saying that you should want to change things. We have clients that if they don't want to adjust lifestyle at all through market volatility, there's ways in their financial plan that we can kind of manage that. And, whether that's by having them withdraw a little enough from their portfolio to get through it. We talk about the 4% rule a lot, right? If you're not withdrawing more than 3-4% of your portfolio, we're not too worried about the impact of volatility over time, right? Whether it be getting more conservative to make sure that, hey, even if the market does go down, we've got money set aside to make sure your expenses are fully funded. But if you are wanting to be, if you are in the building wealth, or if you were wanting to try to take advantage of, or be smart about market ups and market downs, I think it's reasonable to have, again, the way I think about it is like a playbook, right? We have a certain playbook that we pull out when markets are down, and we have a certain playbook that we pull out when markets are up. And just make minor changes to be thoughtful about what we're doing.
Maybe I'm a bit weird, Brent, but my reaction to down markets, and my clients are like, well, it's easy for you to say because it's not your money. It's like, well, first of all, my money's invested the same way yours is. I'm pretty aggressive in my portfolio. Secondly, my entire business model is built on, investable assets. So if this whole thing falls apart, I lose not only my portfolio, I lose my job, I lose everything. But I don't lose a wink of sleep because I have a lot of confidence in the economy. I understand the mechanics. I do believe that markets are not entirely efficient, but for the most part, like when it comes to perfectly timed, buy now, sell now decisions, I think it's impossible. So I put all my faith into into what I consider it to be a natural law, and that is the desire for humans to self-improve. So, and the manifestation of that, economically speaking, is a growing economy. You wake up in the morning and you don't say to yourself, "Okay, Brent, how can you harm yourself today?" It takes a special kind of person to wake up with that attitude. Collectively, we all as humans all make that same decision. For the most part, we wake up thinking, how can we improve our day? We may do it subconsciously, but we all generally do that. And we find a way to improve our lives. And a lot of that involves economic progression. And sure enough, given enough time and enough people, we tend to improve our economic situation, and then the stock market tracks that. So eventually, yeah, we're going to have a downturn, but eventually, assuming that law of nature holds true, we're going to have a recovery. And we've had a recovery from the Great Depression, from, here we're looking at the different sell-offs we've had since early 1900s. So we had the Great Depression.
So far, the stock market has never gone to zero. It has only ever
neither
gone
is
up.
Gold, neither is real estate. It's miraculous. Like, we freak ourselves out to think that, all this stuff is going to pot, and we better. I don't know what people are thinking, but I get the sense that people are thinking, I need to take everything out, put it in paper, which is what the dollar is, and then bury it in my backyard. It's like, okay, good luck with that.
Market volatility, periods of ups and downs are not new.
They're not new, and we survived every one of these, and we ended up, at higher prices, so that the equity markets continued to grow.
Yeah.
Yeah.
So the statistic I'm looking at here is that since 1950 through March of last year, so this doesn't include the last 12 months, there were an average of 16 new highs every year. Okay, so 365 trading days. Of those 365 days, or not trading days, but 365 calendar days in a year, of those, we got 16 new highs. And it's just amazing. I mean, what other asset class hits new highs 5% of the time, or whatever it is, but over that same time frame has compounded at, like, let's say roughly 10% returns per year, right? And I don't think we're in disagreement. I don't know if you're arguing with me with what you're saying about market timing.
I'm not arguing with you.
I don't think we're in disagreement. I think good financial planning, it's really hard because we don't know the future. And so good financial planning isn't about always predicting the future correctly. It's about tilting the scales a little bit to making slightly better decisions on a more frequent basis, a lot of times over a long period of time, to materially improve your situation. And I would argue that in down markets, there are opportunities to make those slightly better decisions.
Yeah. But my point was, I don't think you should obsess about it. So if you're thinking about your portfolio and what it's doing right now on a daily basis, that's too much.
Well, no, I guess what I'm suggesting isn't to think about it on a daily basis. It's to work with an advisor, have a financial plan, and know in your situation, here are the levers that you can pull when the market is down versus here are the levers that you can pull when the market is up. And I think it's important not to be reactive in those levers, but to instead know ahead of time, here are the 3 or 4 things that we can do when we get into periods of market stress that can help me take advantage of that. And that list can include a lot of things. It depends on who you are and the life you want to live and how you want your market, the market to interplay with your lifestyle and all of those things. But make no mistake, I mean, everybody out there has something, even if it's as basic as don't sell, that they should be doing in a downturn.
It's funny, I don't think people like that. They don't like the term, when you tell them don't sell, just hang in there, because it sounds like a non-solution. You're like, okay, well, I guess I'm just going to stay in the firing line then. How fun is that? But that is the solution. That is what you do. You don't want to do anything that is disruptive to your financial plan. And if you don't have a financial plan, well, you came into this unprepared. You need to have a plan. You need to understand what the purpose of your money is, why your allocation is the way it is. So assuming that you have laid the groundwork, you are prepared for an economic downturn. And
I would argue this is one of the bigger values of a planner. Like you asked me at the beginning of this, how are my client conversations going? And I would say that on the whole, while nobody likes losing money, I have yet to talk to a client that is excited about losing money. The conversations that we've had ahead of time and the planning that we've done has clearly made an impact, because what I'm noticing is that people are more calm. They're more, they're not happy. Nobody's excited to lose money, but they're steadfast. And I think that there is a lot of value, as we always say on here, to regularly revisiting your plan so that you can, there's this concept of visualization.
Mhm.
The example here, the story is that like Michael Phelps is a really, I guess, a really good example of this. If you look at Michael Phelps before he swims, he's like closing his eyes a lot of
Mhm.
the times. And what he says is that he's essentially in his head picturing the whole swim, right? Like he's playing it through in his mind. It's called visualization. And there's statistics that would say that your ability to kind of close your eyes and put yourself in the situation and actually visualize what this might look like over time allows you to be more effective. And I think that a financial plan is a really good example of that, because it is just so hard conceptually to see 20 and 30 years from now, or even 5 or 10 years from now when you're going through these things. And sometimes having a financial plan allows you to see the forest for the trees, so to speak.
Mhm.
And again, remain emotionally vigilant in these periods of time, so that, because I think back to your point, you shouldn't be super stressed on a day-to-day basis based on the news. I still think there are smart plays and smart things to do when the market's down, depending on who you are and what you have going on.
Yeah, people get caught up. They may like this message of you have a plan and stick with the plan. It sounds very mundane, and it is, but it's often disrupted by the message that we get bombarded with from all sorts of media these days, and that is this time it's different. This time is different, and you really need to digest the media, understanding the media's bias. Every single platform, every single media, including this one, that you listen to has an incentive. Most media, the incentive is for you to tune in. They want you to tune in, and they're going to use hyperbole. They're going to use fear tactics because fear sells more than positivity. It just does, and everybody knows this. So, you need when you hear hyperbole and any message that you're consuming, like the tariffs are going to cause a recession or a very deep recession, or you could also hear that the market's going to fall 20 to 30% from present points. These are extreme messages that you should probably discount to some extent, because they're designed not necessarily to deliver truth to you, because they don't know. They don't know where markets are going to be. Nobody knows where tariffs are going to be, just like nobody knows what the result of your chemotherapy treatment is going to be. But you can at least listen to these messages, consume these messages, but discount them through a reality lens, because if you don't, then what it's going to cause, what it's going to trigger in you is the belief that, that maybe this time is different. And that creates an internal anxiety that then results in poor behavior and poor actions. Most of the best days in the market happen closely
After the worst days.
after the worst days. And the messages when these negative hyperbolic messages they resonate the most is at peak pain points. And I would argue that we could be at a peak pain point right now. Markets could deteriorate further. We'll see. I do think that it is worth touching on our projections a little bit, because I think you and I both have opinions on where this whole tariff and tax legislation is heading. We touched on it last week, but I think it's worthwhile to kind of read the tea leaves now.
Well, I want to point out, okay, so I have one more chart that we can put in the show notes here, but this is a chart from Charlie Bolello from Creative Planning. We've used a couple of his charts in this episode. The first one was showing the worst 65 trading days. You've all heard that. But this one shows the biggest 2-day percent declines in the stock market and what happens after that. And I want to bring this up last because I think this chart is very encouraging. There is a sea of green on this chart. We have just gone through Thursday and Friday of last week were the fifth worst 2-day drop over the last, since 1950. So over the last 75 years, give or take. Okay. We had a negative 10.5% drop. The worst one was negative 24.6. Best was negative 9.0. we then the chart then looks at forward returns 1, 3, and 5 years out. Okay, so every the other 9 times historically over the last 75 years when we've had a drop like we just saw last Friday, what does the stock market look like a year from now, 3 years from now, 5 years from now? The average 5-year return is 121%. The 1-year return, the lowest 1-year return, 9%, highest 1-year return, 62%, highest 5-year return, something like 164%, even the lowest 5-year return, 88%. So think about the money that you have in your account right now. I mean, everybody, what do we always hear from clients? It's going to take me so many years to make this up.
Yes.
We always assume that the downs are so fast and it's just the ups are going to be so slow and it's just going to take so long. But we forget, like, the backs of these downs are when you get the fastest up. Well, so take your money.
Well, Brent, real quick, I'm going to pause real quick. The reason why a lot of people feel like that is true is because they have capitulated. They went through the downturn, they capitulated, sold at the losses, and then they decide to slowly re-enter into the recovery. And yeah, if you do that, it's going to take you forever to recover.
But if you stay invested, the statistics are overwhelmingly positive that, and again, we can't guarantee anything. I don't want to, be misrepresented here, but historically speaking, over the last 75 years, your chances of doubling your money over the next 5 years are very strong.
Yeah.
So go look at your accounts today and double it.
Yeah, historically speaking. And you may think, well, Brent, you are biased. Of course you're going to say that. You're in the business of selling stocks. No, we are not. We are in the business of doing financial plans for clients.
I want to be here along with you while you double.
Yeah. I don't care if my clients make the most money with stocks, with bonds, with crypto. It doesn't matter. My objective is to build a sensible allocation for clients. I want to see them build wealth regardless of how. We're just telling you our objective opinion on, where we see stocks heading from here. And I think that we all believe that they're going to recover. We can't tell you when, we just know that they will. So here's my segue to say, I'm gonna use that as a segue into the tea leaf reading here. I think that we're probably going to see choppy markets until mid to late summer, because I think that it's going to take that long to for this back and forth, tariff and trade negotiations to finally come into not focus, but clarity. But also, I think what's going to catalyze this, because the tariff discussion is only one leg of the administration's strategy, and I like what you said in breakfast earlier. It doesn't matter if you agree with the administration or disagree with the administration. I think we can all agree that we hope this gamble works. We want this to work, because if it doesn't, it could be pretty ugly. We could see a recession. I think it's not the end. It's not going to be a depression, but it's not going to be, a quick snapback V-shaped recovery. So, in the market at least. But here's what I believe is going to happen. I think that we're going to see the tariff negotiations mostly succeed. There's going to be a few outliers, and the media is going to focus on them because media, again, it's easy to sell negativity. So you're going to see a couple hot, tension points. But for the most part, I think it's in everyone's interest to come to the table with a trade deal. Now, I think that it's going to involve some level of tariffs. I'm not so optimistic to think we see 0% tariffs and everything. But I also think that we're going to see this coupled with, some pretty significant changes in tax legislation. We did touch on this in last episode. It's interesting that you, talking off the podcast, you had a thought that the high tax brackets were going to get monkeyed around with. So we were probably going to see, before we didn't think that we're going to see a permanent change in the TCJA.
I'm just not convinced that the Trump tax cuts are going to get extended exactly how they look now.
I agree with you. And you think that what could potentially happen is we see even lower taxes for the lower income brackets, and then potentially an increase in taxes in the higher brackets, which would melt minds, because that doesn't defer all too much from the Harris
It's a
campaign.
progressive tax strategy. Now, I
Correct.
don't know that this is going to be the case, but I know this morning I watched an interview with Scott Bessent on CNBC, and they talked about the notion of increasing the top tax bracket. And he definitely didn't object to it.
Yeah.
So I think that there's this assumption that the Republicans are just going to extend the Trump tax cuts as they were written originally. We've all heard how expensive that is projected to be, $400 billion a year, $4 trillion over 10 years. So and there's talk that the Republicans can get this through without reconciliation now. So we'll have to see.
Because the CBO uses some pretty crazy assumptions. I also heard Scott Bessent talking about these assumptions on a recent interview, and he basically stated that the tariff tax income is not even included in this.
Well, I don't know that you can rest your laurels on tariff tax income for it, but the point is, I don't know if it's maybe overly presumptuous of us just to assume those cuts are going to look exactly like they do. I think there's some likelihood that they get rewritten in some sense. And I think what Donald Trump has maybe started to prove at the beginning of this first 65 days or wherever we're at is that, we assumed that Donald Trump was a president for the elites. Right, the richest of the rich, and I don't know that his actions to date have really been actions that are consistent with a president that wants to help the billionaires and not help the.
Yeah, we'll have to see how it all settles. So we'll have to see how the tax legislation ends up, because it's definitely going to happen, and I think that could be a catalyst for a market recovery, because if we see an extension of the TCJA. Even if it changes, and I do think we are going to see some significant changes. For one, I think we both agree that Social Security income tax is going to probably go away or be significantly reduced. And they're still talking about no taxes on overtime and tips. So we'll see.
And I think you could potentially see the SALT cap get increased. I think there's a lot of political will to pushing that limit up.
I think what it's going to be designed for is whatever tax income is brought in from the tariffs, they're going to look to that tax legislation to get 100% of that back, or close to 100% of that back, in the form of tax reductions on ordinary Americans. So I think that could be something that the market likes, and that might be the catalyst for the second half recovery. Plus earnings, earnings have been strong. Employment numbers have been strong despite the federal job cuts.
Yeah, this recession that everybody's talking about is imminent. It's still not overly clear whether or not it's going to happen. I mean, I'm not saying it's not. I'm just saying that we haven't seen it show up.
I read an article yesterday. It was a white paper, not necessarily an article, from KKR, and I didn't agree with all of it, but one thing that they suggested is that that the increase in tariffs is potentially going to drag our GDP down by 2.6%, and the DOGE spending cuts, if followed, are going to decrease GDP, U.S. GDP by 60 basis points. So that's a total of 3.2%. And if that happens, there's your recession right there. But it's not a deep one. But I don't know how they came to those numbers, and I kind of disagree with the assumptions that they made in some areas. So I think it's more of like a half glass empty point of view. But we'll see.
We've done a lot to price a recession. I mean, the average recession is something like a 25% market drop.
Yeah, I know. And here we are.
Well, yeah, and so I don't know. The market has done a lot to price some of this stuff in quickly. So. We'll see. But for the listeners out there, this episode, we've talked a lot about investments. We've also touched on tax in here. We have plenty of other episodes that you can go listen to. Our most recent episode before this one was about how to think about looking at your tax return and how to catch mistakes in your tax return. I mean, all of these things, again, it's good financial planning doesn't rest on one solid decision. It is the culmination of marginally better decisions over long periods of time around tax, behaviors, taxes, investments, right? And so we appreciate you listening, and we hope that we are helping you approach those things just a little bit better than you might have otherwise. And and ultimately improve your financial position.
Yeah, make sure you subscribe to the podcast. We're gonna continue to bring relevant content to the table, and our hope is to add value to your life and help you build wealth. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Any company names noted herein are for educational purposes only and not an indication of trading intent or a solicitation of their products or services. Advisors associated with National Wealth Management Group may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of National Wealth Management Group. Or 2. Solely investment advisor representatives of National Wealth Management Group and not affiliated with LPL Financial. Investment advice offered through National Wealth Management Group, a registered investment advisor and separate entity from LPL Financial.